welcome to the MIT System Design and Management Program's Systems Thinking webinar series. We're very pleased today to be presenting one of our favorite alums, Sascha Boehme, who will be speaking about Bitcoin, systems, architecture, opportunities, and challenges. Before he begins, I'd like to remind everybody about a few things. First of all, if you would kindly make sure you're muted, that would be much appreciated. If you have any questions, please enter them directly into the chat section addressed to everyone. And Sascha will be taking questions, or answering these questions about 45 or 15 minutes after he completes his presentation. Also, if you are interested in a more in-depth webinar, please send an email to me. My name is Lois Slavin. I convene these webinars. My email address is lslavin@mit.edu. Just let me know if you are interested, and we'll see what we can do. And with that, I am going to turn this over to Sascha.
Thank you very much, Lois. Welcome everyone to today's webinar on Bitcoin. As Lois just mentioned, we're trying today to do something in 1 hour that over the past 2 days at MIT has happened in 48 hours. There was a MIT Bitcoin Expo. So we'll try to do as much as possible as we can. And I would like to start with a question. Why should we care about Bitcoin? And the answer to the question is a quote from Satoshi Nakamoto. The only way to confirm the absence of a transaction is to be aware of all transactions. And this captures the essence of why Bitcoin is important better than anything I can think of. Let me give you an example. Let's say you have only $10 in your account and no credit line, and you want to buy groceries for those $10. You could do this in several different ways. You could go to the ATM, take out $10, then go shopping for groceries and pay in cash. Or you could go shopping right away and pay with your credit or debit card at the checkout. And when you swipe your card at the terminal, the banks, payment processors, and card networks verify that you have enough money in your account to pay, and also that you're not a thief using a stolen card. So what you cannot do is go to the ATM, take out $10, and then quickly run into the store and use your card to pay for groceries and spend those $10 again. This is called double spending. And you try to spend the same $10 twice. And the current payment system confirms you didn't already empty your account at the ATM. That means it confirms the absence of that ATM transaction, and thus creates trust that the later transaction in the store is valid. And so if your transaction goes through in the store, the owner knows he will receive his $10 into his account. And this idea of preventing double spending is important because the economy and society as a whole is based on exchange and transactions. So what's the problem with that? Well, for starters, banks charge fees for this service. The global economy is worth over $80 trillion, and the fees associated with running the global payment system alone amount to about 2 to 3% of that, which is a couple of $1 trillion spent on overhead maintaining the system, instead of being used for other purposes like research or innovation. But it's not just about money, it's also about trust and power. So the players in the payment system, they act as central authorities, right? They belong to a small group of organizations that collectively know everything about everyone's payment history and account balances, and that have control about if and how we access our funds and the payment system. So the fate of the entire monetary system depends on this small group where all the power is concentrated. And this power can be abused, as we have learned most recently in the 2008 financial crisis that still is going on. So the current system is far from perfect. It's expensive and inefficient and vulnerable to abuse, but it's all we have to facilitate transactions, at least until 2008. What Nakamoto did with Bitcoin was to create a new system that for the first time in history allowed people to transact with each other without the need for a trusted third party, while still avoiding double spending. So this reduces the cost of transactions dramatically and distributes the power and control over our assets away from central authorities back to the individual. And the image you see here represents a chain of transactions in this new system. And that's what a Bitcoin is, a chain of transactions. So now that we know why Bitcoin is so important, we can talk in more detail about what it is, its systems architecture, and the opportunities and challenges it faces. So what is Bitcoin? Well, Bitcoin is a cryptocurrency. We know that. But what does it mean? It's a currency, so that must mean it's money, right? And what's crypto? Is that short for kryptonite? So is Bitcoin like a Superman dollar? Well, the Canadians actually already came up with that. This is the image of an actual Canadian dollar coin. I did not make this up. When I thought about this, I Googled Superman dollars, and this was the first hit. But that's not Bitcoin. Bitcoin.org says Bitcoin is a new kind of money, an innovative payment network, and a peer-to-peer technology. So what is money? And is Bitcoin money? Money is a medium of exchange, a unit of account, and a store of value. So is Bitcoin money? It's already a medium of exchange. Merchants accept it, and people have been sending Bitcoins to each other for years. You can now exchange Bitcoins for dollars or other fiat currencies. Is it a unit of account? Well, are we currently running our balance sheets and pay our taxes in Bitcoin? No. So it's not a unit of account. And is it a good store of value? Well, it's highly volatile. In December 2012, it was worth about $13. In December 2013, it was worth over $1,000, and currently it's around $280 as of this morning, with wild swings in between. So it's not a good store of value. So Bitcoin exhibits some properties of the classical definition of money, but not all of them. But we could argue it is a kind of money. And we also said it's a cryptocurrency. So it's more than regular money. It's a bearer instrument based on digital cryptography, which means it derives trust not from a government or central authority who issue legal tender like the dollar, or from chemical or physical properties like gold, because it's digital. It derives trust from mathematical properties based on established, trusted cryptographic principles that allow it to verify that transactions are valid and so is immune to double spending. And then we also said Bitcoin is a peer-to-peer network. And that's what makes Bitcoin different from previous cryptocurrencies. It's decentralized, distributed, and democratic, without a central mint or other authority, which means everyone on the network has the same rights and has complete control over their coins. No organization can freeze your assets or take them away from you, and no central mint is creating coins at will. This is what makes Bitcoin the first completely decentralized payment system. So how does Bitcoin work? I've tried to sum this up in one slide. There are great resources that discuss in great detail how Bitcoin works, and I'll put a list together at the end of this presentation for your further reading. But these are the basic terms everyone trying to understand Bitcoin should know. So first of all, Bitcoin with a capital B is the protocol or the technology. And Bitcoin with a lowercase b is the currency or a coin being sent around and the unit of account in the Bitcoin system. And a transaction is the transfer of a coin from one owner to the next, signed cryptographically, which means that only the owner of the coin can send it, and once signed, the transaction cannot be modified or reversed if it was valid. The transaction requires two keys. The receiver's public key, which is known to everyone and serves as the Bitcoin address, similar to a bank account, and the sender's private key, which is use like a password to unlock his own account to get access to the coins he wants to send and which he needs to keep secret. About every 10 minutes, a block is created through mining and attached to the previous block. It contains all transactions that occurred since the last block. Mining validates transactions through a concept called proof of work. And when they get included in a block, the transactions are deemed confirmed and irreversible. Mining also attaches the new block to the blockchain, which is a timestamp sequence of linked blocks and serves as a ledger, which is public and contains the entire history of all transactions and is visible to everyone. Now, proof of work is a concept that helps secure the blockchain. It's a complicated mathematical puzzle that is very hard to solve, but very easy to confirm once a solution is found. It's like Sudoku in a way. It only takes a few seconds to check the 9 rows and columns to see if it was solved correctly. But to solve it with only a few numbers entered takes considerably longer. You can't just guess the solution. If you sit alone in a room and solve a Sudoku puzzle, you have proven that you put in the work required to solve it. In Bitcoin, as a reward for this effort, the miner receives new Bitcoins and doing away with the need for a central mint. This is an important element in ensuring the security of the blockchain. So, what does a Bitcoin actually look like? This is a paper wallet I printed out this morning, and it basically contains the 2 keys that we just talked about. In the private key and a public key, which are just strings. And don't bother trying to spend the money that's in this wallet. There's nothing in there, I promise you. And you can create as many Bitcoin addresses as you like, in fact. It's suggested you should create a new address for each transaction. So there's no way to tie the same person to multiple transactions, and thus possibly glean their real identity from it, which preserves anonymity. So to sum up, Bitcoin is decentralized, distributed, and democratic because it's a peer-to-peer network without a trusted third party to validate transactions or mint coins. It's anonymous. The real identities of senders and receivers can stay hidden. And transfers are nearly instant, cost almost nothing, and they are irreversible through cryptography and by timestamping each transaction and creating a chain of events that was witnessed by everyone on the network and that cannot be changed. That's the blockchain. That also makes the network and everyone's coins secure and prevents double spending. So now that we know what Bitcoin is and how it works on the surface and what its properties are, we have the right context to look at its system architecture. Now, system architecture is a very wide field, and I would like to focus on one specific part today, and that's the needs to architecture framework. One of the principles of systems architecture says, good architecture meets the goals of the system. And this sounds trivial, but I'm actually starting every of my projects with this framework. Everyone who has experience in engineering or product development knows the word rework. If an upstream task hasn't been done right, a problem might occur further downstream. For example, a dependent task can't be completed, right? We then have to analyze the cause and loop back upstream and do it again. And the further upstream the mistake has happened, the graver the consequences are downstream, and the more costly it is to fix. Worst case scenario, the finished product or system doesn't do what it's supposed to do. And so there's been a lot of discussion around Bitcoin and if it's useful or not. Also on the conference yesterday, there were a lot of different opinions on it by technologists, economists, bankers, the press, and so on. And often those discussions circle around the fact that Bitcoin claims to be money, but it has no intrinsic value, and it is not a good store of value or unit of account. But I'd like to take a more systematic approach here. So to analyze if Bitcoin's architecture is good and meets its goals, we can use the needs to architecture framework. It tells us how to synthesize a system based on the needs of the stakeholders from which the goals are derived and ultimately the architecture. So, in his paper, which was published in November 2008, Nakamoto talks about a new system he's been working on, an electronic cash system that allows online payments. Okay, so clearly we're looking at a payment system. So the first step is to look at the stakeholders in the current payment system and assess their needs and goals. And then in the second step, we can see if Bitcoin meets these goals. So the first step, we look at the ecosystem as it is. Following Professor Crawley's framework, there are stakeholders and beneficiaries of the system. Beneficiaries are those whose needs are addressed by the system's outputs, and stakeholders have a stake in the system, either by producing an output that fulfills others' needs, or because they're important to the system otherwise, which means they exert some form of control over the system. And so this leads to three different stakeholder groups. The primary beneficiaries, who only receive value from the system, but don't exert any control. On the other spectrum, we have the high-leverage stakeholders, who don't need the system, but who exert control. And in the middle, the beneficial stakeholders, who both influence the system and get value out of it. And the stakeholders in the payment system are as follows. We have primary beneficiaries. These are the users of the system, the parties to the transaction, payers and payees, which also includes consumers, businesses, and even institutions that are paying each other with Bitcoins. The beneficial stakeholders fulfill the needs of those beneficiaries in the system, and in return they receive some compensation. This group consists of banks and credit card companies and payment processors and so on that own the network and operate the current system. And then there are the high leverage stakeholders. These are the government entities such as regulators and policymakers and central banks. And they're critical to the system because their output, such as approvals and licenses, is absolutely required for the system to operate. However, they don't directly benefit from the system itself. They're not the primary beneficiaries. Their needs are different, and fulfilling the needs adds a burden to the system. So what are the needs of the primary beneficiaries for whom the system has been built? And what are the needs of the high-leverage stakeholders, which the system absolutely needs in order to operate? Well, as a primary beneficiary, I want security, which means no theft, fraud, or double spending. I want irreversible transactions that are valid. That means transactions that go through where the sender has the funds and the payee account exists, and he is actually the intended receiver, and where one party cannot just reverse their payment. For example, once a buyer receives his good from the merchant, he can't just cancel his payment. I want fast transfer. Currently, it takes a day or two for domestic transfer in many countries, and international transfer can take up to a week. I also want transfer to be cheap. Currently, there are fees even for domestic transfer between different institutions in some countries. And it's absolutely impractical, for example, to send $50 to Germany, where I'm from, because the fees would eat up the whole amount. Ease of use is important because the system is supposed to be used by absolutely everyone, regardless of skills or education. And I'd want the transaction to be direct between me and my counterpart, especially if I don't trust the middleman. And then we have anonymity. That is something that was very important for Satoshi Nakamoto and like-minded groups of people who believe in total anonymity and who he designed the system for. So it is a need of the intended beneficiaries. But you could argue that it may not be important to the majority of users of the current system. We don't have a problem showing our ID at the bank or showing our face to the bank teller. So just look at what people are posting about themselves on Facebook. On the other hand, going forward, when it comes to money and security, maybe people prefer anonymity. This last point is the subject of great debate. Now, the needs, on the other hand, of the high-leverage stakeholders are preventing money laundering, terrorist financing, and other criminal activities, consumer protection, and monetary control, i.e. setting interest rates and controlling money supply. So with the needs of the primary beneficiaries and the high-leverage stakeholders and the goals the system needs to achieve, we can now formulate a system problem statement. We'll ignore the beneficiary stakeholders here because they form the current system which Bitcoin is trying to replace. We want a system problem statement so we can synthesize the system from the needs to goals to the concept and ultimately the architecture. So the statement could be this: to provide willing parties a means to transact directly with each other without the need for a trusted third party, that's the need, by transferring a unique piece of digital property using an electronic payment system based on cryptographic proof instead of trust, that's the concept, while also being secure, ensuring transactions are valid and irreversible, being fast, cheap, and easy to use, providing anonymity to the parties involved, complying with pertinent regulation, and allowing monetary policy. So as system architects, we would go from here and synthesize the system. However, Bitcoin already exists. I don't know if Nakamoto took this approach and wrote a system problem statement, but if he is listening, I would like to hear his feedback. In our case, the system problem statement now gives us means to measure the quality of the architecture. So let's see how Bitcoin compares, or Bitcoin's architecture fulfills the needs and goals of the system, and how it compares to what we currently have. So based on the properties of Bitcoin from the previous section, we know that Bitcoin is distributed and decentralized and democratic because it's a peer-to-peer network. So parties interact directly with each other without a trusted third party. It's also anonymous, and transactions are fast, cheap, and irreversible once validated. So in all these points, the current payment system does not fulfill the needs and goals of the primary beneficiaries as well as Bitcoin does. It's certainly not P2P or anonymous, and transactions are far from fast and cheap, especially internationally. And some card transactions are actually reversible, so-called chargebacks, leaving, for example, the merchant who sold a good without the good or the money. Next is security. The Bitcoin protocol itself is secure. Breaches on exchanges and thefts that made the headlines have nothing to do with the system created by Satoshi Nakamoto. These were mistakes made by the companies built on top of that Bitcoin protocol that have weaknesses in their own infrastructure or were run by crooks, but users entrusted them with their private keys. In the current payment system, on the other hand, there have been breaches where millions of cards and personal data have been stolen and been used to take people's money. However, I gave the current system half a point because there are mechanisms in place, and these events are relatively rare. And consumers are insured against it, for example, via the FDIC. However, this extra consumer protection comes at a price, and is one reason why transactions in the current system are more expensive than with Bitcoin. No double spending, that means a ledger that confirms that the funds that are spent are actually in the sender's possession and have not been spent already, is fulfilled by both systems. The blockchain and your bank are all aware of your transactions. Ease of use is a user need where Bitcoin is currently lacking. Creating wallets and sending funds to long strings using QR scanners and such is not as convenient as swiping a credit card or your phone as with Apple Pay. But at last weekend's Bitcoin Expo, there were companies making new wallets that look like credit cards and can be used with one motion and a fingerprint sensor, just like Apple Pay. So the future looks brighter here. And Bitcoin definitely does not comply with financial regulation at the core, especially with anti-money laundering or terrorist financing laws, which require you to identify yourself with your bank, because it was designed to be anonymous. And it does not allow central banks to run their monetary policy. In fact, it was the explicit intention of Nakamoto not to have a central bank that would control money supply. The current system of banks and central banks, of course, does allow that. So Bitcoin fulfills many of the needs of the primary beneficiaries in the system. However, it does not fulfill the needs of the high leverage stakeholders. But why is that? Well, it's because Bitcoin was designed with only two stakeholder groups in mind. The primary beneficiaries on one hand and those that run the Bitcoin network on the other hand, i.e. all the nodes and miners that transmit and confirm transactions on the network and maintain the blockchain, and all the companies that leverage the blockchain technology to provide a host of new services, which together form the Bitcoin ecosystem. The high leverage stakeholders were left out intentionally because they contradicted the goals and needs of the primary beneficiaries, and because of the burden they are adding to the system. These are the beneficiary stakeholders of Bitcoin. They all try to generate value for the primary beneficiaries, the payers and payees. There are wallets, exchanges, financial service companies, payment processors, and of course miners. And actually all except miners are not entirely necessary to make payments on the network, not even the wallets, because Bitcoin is open source and it's actually possible to build your own wallet, although that's very difficult for most of us. However, all these companies are there to provide ease of use, to make payments simpler, and to provide additional services. For example, to change dollars into Bitcoin online. Previously, the only way to get Bitcoins was either to mine them or to pay somebody in cash for exchange of that piece of paper I showed you before. So ease of use is definitely improving rapidly. And so the question is it actually necessary to consider some or all of the needs of the high leverage stakeholders in order for Bitcoin to succeed? And this is a huge point of contention. Many believe the high leverage stakeholders are necessary because they don't exert control over Bitcoin, much like nobody controls the internet. However, I belong to the camp that believes, while it's true that high leverage stakeholders cannot turn off the internet, the companies in the ecosystem we just saw that's developing on top of it, they do require approval by the regulators in the respective jurisdictions. And so if we want to bring Bitcoin to the masses, all the players in the new payment system have to get together with regulators and work out how to fulfill some of the regulation that is intended to protect consumers and society, while at the same time not stifle innovation with overly burdensome regulation or render the whole Bitcoin network useless. Yeah? However, there will be a trade-off between the goals of the primary beneficiaries and the high leverage stakeholders. That's why I put these brackets around anonymity. Increase on compliance, for example, with anti-money laundering laws and know your customer regulation will inevitably mean less anonymity. But if this happens, Bitcoin has the potential to replace the current payment system. Not the whole banking system per se, because banks have other functions, such as extending credit and, of course, being part of every government's monetary system in their own currency. Which is actually why Bitcoin will never be able to fulfill the high leverage stakeholders' goal of allowing monetary policy. It can't. It's not the currency of any government. In fact, it's no one's and everyone's currency. So this is the top-level analysis of the system architecture. In the next presentation, hopefully, we can go deeper and analyze how well the protocol and the cryptographic mechanisms meet the goals of the upper levels of the system. We might find that some results are not optimal. For example, the fact that a block only gets mined every 10 minutes, which is why Bitcoin is not the only cryptocurrency. In fact, there are hundreds. They're called altcoins. And some variations to the Bitcoin protocol are in altcoins, and other altcoins have a completely different algorithm. One reason for that is that not everyone agrees that Bitcoin protocol is the best way to disrupt the current payment system. So now let's look what opportunities Bitcoin holds in store. We already talked about money transfer. Mervyn King, the governor of the Bank of England, already said in 1999, there's no reason in principle why final settlements could not be carried out by the private sector without the need to be cleared through a central bank. So even central bankers foresaw payments possibly going through private networks. More efficient online payments, that is the use case that has gained the most traction so far, as more and more merchants started accepting Bitcoins. Small businesses, they often operate on razor-sharp margins, and many have an online presence to increase their reach of customers. And while credit cards are helpful in making that transaction easier, they come with high costs to the merchants. So businesses want to offer credit card payments as an option to their customers, need to pay for a merchant account with each credit card company. So depending on the terms and conditions, they must pay a variety of fees, authorization fees, transaction fees, and so on. And these quickly sum up to an average of around 2 to 3% per transaction, plus running flat fees that eat up most of the additional profit. So Bitcoin removes those charges. Small businesses have already adapted BitPay as a payment processing company because of its ability to lower the cost of doing online commerce, even across borders. And even large retailers like Overstock and other big names such as Tesla or Dell now accept Bitcoins as a way to avoid the cost of doing business with credit card companies. And of course, it's great for marketing. The early results indicate actually that customers paying with Bitcoin spend more on average, and they're mostly new customers. So both effects add to the bottom line of businesses. And others have adopted it for its speed and efficiency in facilitating transactions. Some merchants may not even qualify for being allowed to accept credit cards at all because they fail the credit check. That's the niche that Square, a payments company, used as a beachhead to start their business. Bitcoin companies can do the same, but even cheaper. And accepting credit card payments also exposes businesses to chargeback fraud, where consumers initiate payment reversals pretending that a product has never been delivered, and merchants can lose the payment for the goods and the item itself. In addition, they have to pay a fee for the chargeback. So Bitcoin eliminates this kind of fraud because payments are irreversible. Of course, these chargebacks have actually benefits for consumers when they're honest, because they protect them from the opposite risk of shady merchants keeping the payment and not sending the goods, as well as from honest merchant errors. And there are other benefits to credit cards, such as rewards and insurance, that are funded by credit card fees and that consumers may want. So many consumers and merchants will probably stick to credit cards, but Bitcoin offers more alternatives to everyone that haven't been there before. Merchants and consumers can pick what they like best. And not having to pay for merchant fees enables merchants who accept Bitcoin to pass the savings on to their customers. That's the business model of the Bitcoin store, which sells thousands of consumer electronics at discounted prices and only accepts Bitcoins. In this way, Bitcoin provides more low-cost options to bargain hunters and small businesses without removing the option to use traditional credit card services. Right? In addition, new companies like Circle and Coinbase, they make it easier to exchange your dollars into Bitcoins and hold them in online wallets and transfer them to individuals or to make purchases. And Circle even insures the deposited funds, which is a novum in this industry, similar to a bank. But most importantly, at this point, most services are free. Roughly 2.5 billion adults in the world don't have access to banks and are cut off from a financial system which many for us take for granted. They can't start saving accounts, they don't have checking accounts, and they can't get credit cards. They live in places where banks don't want to go, and sometimes they don't even have IDs. And because of this, they remain effectively excluded from the global economy. Without savings accounts or access to banking services, people in emerging markets have a difficult time building up lasting wealth. So to supplement their income, families send their children to work as well. They can't even begin to think about a better education or fighting oppressive governments. And banks won't service these people for various reasons. It's partly because the poor don't offer the same profits as the wealthy, partly because they live in places where there isn't infrastructure and security that's needed for banks to build physical branches. But mostly it's because of the lack of legal institutions and laws. Without documentation to prove the identity, to put up collateral, and to create credit histories, these people lack the basic requirements for participating in the banking system. This limits them to cash transactions. A whole tier of shadow banking has arisen to meet their needs, but it typically involves money transmitters who charge huge fees. And so one of the biggest and most exciting prospects for Bitcoin is to bring these billions of people out of poverty. Bitcoin doesn't care who you are. It doesn't care how much money you're willing to save or spend. You and your identity and even your credit history is totally irrelevant. But Bitcoin allows you to send or receive money from anywhere, financially integrating a third of the world's population. That could create many new opportunities for world trade and for attacking poverty. And so one of the first use cases that has the largest potential to do so is remittance. The international remittance market has a volume of around $500 billion. And millions of low-income workers send money back to their families in developing countries, who often survive just on the bare minimum. As the funds travel through the international payment system, financial companies in the value chain like Western Union or MoneyGram extract fees of up to 10%, sometimes more. And the funds take days to arrive. In other cases, migrants have to send money home through back channels, often random people who are headed in the same direction. Sometimes the money arrives and sometimes not. On top of that, in unstable regions of the world, even day-to-day business is unsafe. Merchants may have to carry around their cash at the end of the day, risking being robbed or worse. So as an inexpensive funds transfer system with fees of a fraction of a dollar, Bitcoin would lower the cost of remittances to a minimum and speed up the transaction. At that price, even say $25 transfer costs less than 1%, allowing migrants and guest workers to send payments more frequently instead of having to save them up to be able to afford the transaction. And these benefits immediately help those most in need and increase their standard of living. In fact, it's hard to think of any other solution that can improve the lives of millions of people in such a short amount of time and with such little effort from the financial and entrepreneurial community. So, for example, Bitcoin company Kipochi partnered with M-Pesa. M-Pesa has been around for many years, and they have helped the unbanked with no access to bank accounts to send and receive money using phone credits. Now, Kipochi allows M-Pesa users to exchange Bitcoins, connecting them to the rest of the world outside the closed telecom system and the existing banking infrastructure that M-Pesa is running on. And with 37 coins, a more recent startup, you can actually send and receive Bitcoin anywhere in the world directly with a phone via SMS. No internet or smartphone or bank is required. So lastly, for the sector on opportunities, because transaction fees are fixed at a very low price, less than about 5 cents at current Bitcoin levels, Bitcoin generates huge cost savings for large transactions and at the same time makes micropayments affordable. Micropayments are transactions roughly around $5. So micropayments have been touted as another one of the main uses for Bitcoin. The reason is that today transactions below $5 paid by credit card are uneconomical, and fees are for transactions below 1% are prohibitive. So, for example, if you pay 99 cents for your iTunes song, and the credit card company charges Apple 20 cents for that, and as a fixed fee plus a percent on top, the fee paid by the merchant is actually over 20%. This is the reason also why fees around in-app purchases on Android and Facebook are around 30%. So many business models based on micropayments have so far been simply not viable. But with fees close to zero and near infinite visibility, Bitcoin can change that. So for example, in the area of content monetization, the one reason media businesses such as newspapers struggle to charge for content is because they need to charge either all, which means pay the entire subscription fee for all the content, or nothing by selling ads, resulting in banners and pop-ups that annoy customers. So with Bitcoin, it becomes economically viable for businesses to charge tiny amounts. Now it's possible for consumers to pay a few cents to finish a Wall Street Journal article without having to buy a subscription, or to pay Wi-Fi by the second on the go if you just want to check your emails. Another potential use of Bitcoin micropayments is to fight spam. Future email systems and social networks could refuse to accept incoming messages unless they came with a very small amount of Bitcoins. Small enough so they don't matter to the sender, but large enough to deter spammers who at present can send billions of spam messages for free. So there are many more benefits and possibilities that arise from Bitcoin. You could, at the conference yesterday, people speculated about fridges that start paying for the milk they're ordering automatically, or cars that park themselves and then pay for the parking themselves, because the Bitcoin protocol allows this kind of innovation. But actually the uses go far beyond payments. Bitcoin can simply be thought of as a piece of space in the ledger that is owned by someone. That someone can keep that space or transfer the ownership to someone else. The space can also be colored to give meaning to its content. At the moment it's just a dollar number, but that really is the price for the empty space that people are willing to pay. Soon there may be something to put into that space, for example shares or other documents of ownership or contracts. So use cases can then include transfer of property, smart contracts with auto execution of clauses, identity management, issuing stocks or bonds, or electronic voting. And the list goes on and on. So it's my opinion that cryptocurrencies are here to stay, based on their properties and the opportunities that we just discussed. It's not clear if Bitcoin itself will survive or if another cryptocurrency will emerge as leader, but the fact that Bitcoin system architecture is sound and that it has the largest user base and developer network, and therefore the strongest network effects, makes it the strongest contender. But what are the challenges that cryptocurrencies and Bitcoin face on their way to mainstream use? The main challenges I see are adoption, regulation, criminal use, and price volatility. And they're actually all connected. So let's start with adoption. If nobody uses Bitcoin, it'll fail. On the other hand, Bitcoin, like any network, becomes more useful to everyone on the network as new members join. This is the network effect. And a currency becomes automatically a valid form of money if it gets adopted by a community, and everyone agrees that it is money. That's how currencies actually develop in history. Adoption in turn is driven on one hand by the utility that users get from Bitcoin, such as cheap and instant money transfer and the other opportunities we discussed earlier. But that utility is affected, amongst other things, by the protection users get from fraud and other criminal elements and from price volatility. So ultimately, that means adoption is driven by trust. That trust, on the other hand, is supposed to be inherent in the technology of Bitcoin, right? We know that the Bitcoin protocol itself is secure. However, since adoption also depends on the ease of use, more and more people started adopting Bitcoin when online wallets and exchanges started to appear, which took some of the maintenance and setup work away from the users. But with that increase in usability came a loss of security, because now the private keys were in the hands of others. Bitcoin in online wallets were lost or got stolen. So trust was broken again. And this is why regulation plays an important role. It is, at least to some extent, designed for user protection, and thus increases the trust in the system and increases adoption. It basically protects us from ourselves. On the other hand, regulation could be burdensome for consumers who have to give away some of their privacy and anonymity, and more importantly, it could stifle innovation for businesses and the developers, thereby actually reducing adoption. Regulation in many countries is unclear or negative, at the moment. You can see from the map. Regulators grapple with the fact that Bitcoin doesn't neatly fit in any existing definition of currency or financial asset or even institution. It falls into a gray area, and it's difficult to know which laws apply and how. This is not uncommon with the emergence of new technologies, and it's reminiscent of the uncertainty surrounding the voice over IP internet protocol. When that first emerged, the FCC had only been looking at voice communication over traditional telephone network and was really concerned with keeping a monopoly from forming. Like Bitcoin, voice over IP was peer-to-peer, less expensive, and competed with long-standing incumbents in a highly regulated market. Luckily, though, Congress and the FCC managed to clear much of that ambiguity without burdening the technology with heavy-handed legacy regulation that would stifle innovation. So as a result, the technology flourished, and we have things like Skype today. Increased competition, and it also led to lower prices for customers. So let's hope that policymakers will do the same for Bitcoin. And since Bitcoin has the properties of a payment instrument and a currency and a commodity and a network, amongst other things, in the US, not just one, but several agencies are faced with questions on how to regulate it. And actually, the first question is around private currency. Bitcoins are not being issued by a federal government, but as a cryptocurrency, they are used as money. So the first question is that actually legal? And the answer seems to be yes. The US Constitution only prohibits states from minting money. Privately issued currencies are legal, and they're actually in circulation. There's a local currency called the Cascadia Hour Exchange in Portland, and others that have been created by local businesses and lawmakers to promote trade and economic growth in their region. So what private currencies may not do is resemble US money, and clearly that's not an issue for Bitcoin because Bitcoin doesn't want to be US money. And then there are the money transmission laws. A business that transmits funds is a money transmitter and must obtain a license where it wants to operate in each of the states. Okay? And it's also subject to the Bank Secrecy Act, which is implemented by the FinCEN, the Financial Crime Enforcement Network. And operating unlicensed money transmission is also a criminal offense under the USA Patriot Act. So because money transmitters aren't FDIC insured, consumers may end up losing their funds if the transmitter doesn't send the money to the payee. So for that reason, state licensing has been enacted for consumer protection. And New York has taken the lead here, starting working on a BIT license under Superintendent Ben Lawsky. Just a few days ago, in February, the New York State Department of Financial Services has released a new revision to the original BIT license proposed last summer on cryptocurrency regulations. Luckily, Mr. Lawsky was aware that he's walking a fine line between protecting consumers and stifling innovation. So he invited the Bitcoin community to comment on the original. It was heavy-handed and greeted with strong resistance from the Bitcoin community. The new document includes changes, for example, reduced record-keeping requirements and a 2-year waiver from full compliance for startups, and more. And he basically said that those changes are primarily focused on providing additional flexibility for virtual currency startups to innovate while maintaining New York's commitment to protecting consumers and rooting out illicit activity. And really, the rules are not any stricter than for banks and financial institutions, according to Mr. Lawsky. Again, that's a big point of contention in the community. The purpose of the Bank Secrecy Act, on the other hand, is not consumer protection, but it's to prevent or detect money laundering and terrorist financing. So it requires the affected businesses to register with FinCEN and keep transaction and customer records and implement anti-money laundering procedures and report suspicious activity, which all go against the anonymity idea of Bitcoin. And lastly, there is the CFTC, the Commodity and Futures Trading Commission, which is involved. And it declared that Bitcoin fits the legal definition of a commodity. And so it says it has the authority to regulate it. They're mostly concerned with market manipulation and protection of the participants in the market. So this is not necessarily a bad idea. Another challenge, of course, is criminal use. And you've all heard of Bitcoin. If you heard of Bitcoin, you've heard of Silk Road. The website was used as a marketplace like eBay, except mostly for illegal goods, and Bitcoin was the currency of choice. Silk Road had an estimated $200 million in sales, and 95% of which were for drugs, apparently. In October 2013, Silk Road was shut down by the FBI, and the FBI ended up holding thousands of Bitcoins, and so turned involuntarily into one of the largest holders of Bitcoins. They auctioned some of them off, and in a way actually giving legitimacy to the currency. What's important to keep in mind is that, yes, it's a challenge, and Silk Road was selling illegal goods for Bitcoins, and the legal market for drugs paid in dollars is actually much greater. So in that sense, nothing has been done with Bitcoins online that hasn't already been done in the physical world with fiat currencies. Right? It's true that Bitcoins help illegal activity because it supports anonymity, but there's still a trace in the blockchain. The most anonymous form of money is still cash. And another challenge in the criminal use case is Mt. Gox, which you may have heard of as well. It was the worst scandal in Bitcoin history and precipitated the burst of the bubble in early 2014. An estimated $500 million worth of Bitcoins were lost. But again, that's not unique to Bitcoin. Right? Fraud and theft happens when you trust a third party with your money, no matter if it's Bitcoin or dollar. A good example is the case of Bernie Madoff, who built a Ponzi scheme worth billions of dollars and which his investors lost. Okay, to our last challenge, volatility. That's also a concern for Bitcoin. At least when it comes to the other two criteria money should fulfill, being a store of value and a unit of account. This price chart here illustrates how Bitcoin prices stayed near zero for the first 2 years, when the community was really tiny and no real-world use for the currency was evident. But since 2011, Bitcoin has had several significant price adjustments. Since 2013, news coverage of Bitcoin has increased dramatically, and with it, the demand for newcomers. That, combined with some hints by the US regulators about possibly friendly regulation and also huge activity in China, drove the price to an all-time high over $1,000 in December 2013. The bubble actually burst quickly afterwards with the fall of Mt. Gox. At some point, the price went below $100 intraday, but it bounced back. And the recent high volatility is already subsiding and even lower now than arguably some emerging market currencies. So these adjustments in price are common in financial markets, which are prone to speculative bubbles. Right? Over-optimistic media coverage of Bitcoin leads to waves of inexperienced investors jumping into the fray and drive up prices. The frenzy reaches a tipping point where the bubble bursts and the price plummets. Newcomer investors that are eager to get in run the risk of overvaluing the currency and losing their money in the crash. And Bitcoin's price fluctuations make many observers weary of the currency's stability. But while some believe this is the reason why Bitcoin cannot succeed, others believe that these fluctuations will decrease in frequency and amplitude over time, as they did with many of the former tech startups that are now household names. And this will happen as mechanisms develop that counteract volatility. Once the euphoria has settled and a fair price has been established, demand will be more stable and become more predictable, in line with the flow of goods and services paid for in Bitcoins, including international money transfer and currency exchange. The volatility causes most concern for those who view Bitcoin as a store of value or unit of account. And that's understandable. It doesn't make any sense to keep books and balance sheets in such a highly fluctuating currency, and neither do long-term investments. at least not at this stage, where not only price stability, but the very existence of the currency are uncertain. So if used exclusively as a medium of exchange, though, volatility is less of a problem. The price risk can be mitigated by quoting goods in traditional currencies and adjust the Bitcoin equivalent in real time, and then selling the Bitcoins for fiat upon receipt. The service has been offered to merchants through startups like BitPay and Coinbase, through a plugin on their website, similar to PayPal's. I'm getting a note that we are reaching the end of the conversation, so I would like to move to our closing page and would like to give you one more quote of the new book that came out just recently by Paul Vigna and Mike Casey, The Age of Cryptocurrency. The digital currency known as Bitcoin is only 6 years old. It is, quite simply, one of the most powerful innovations in finance in 500 years. And I believe this is to be true. Bitcoin put cryptocurrencies and the blockchain technology on the map. The possibilities for innovation are endless, not just in payments, but in business and communication in general. Bitcoin has the potential to alleviate poverty and oppression on a global scale, much like the invention of the internet did. Its development is neither finished nor is it certain that Bitcoin will survive. So the possibilities for failure are endless too. It may fail as a currency, or it could be replaced by a superior cryptocurrency. But it has already made its mark on history, and distributed networks of trust that allow strangers to transact remotely without the need for a neutral third party are here to stay. I hope you enjoyed this presentation, and I'm now open for questions.
Thank you very much, Sascha. For those of you who need to leave promptly at 1, I would like to invite you to our next webinar, which will be delivered by Kevin Schatzkammer, who is an SDM alum and CTO of Brocade. He will be talking on innovations in mobile technology. That will be again on March 23rd, same time. Also, I just would like to remind everybody that the recording of the presentation today and a link to the slides will be sent out to you later this week. So we have 3 questions so far. If anybody would like to add another, please type it directly into the chat section addressed to everyone. We'll take as many as we can. The first one is from a good friend of SDM, Jeffrey Cutler, who asks, aren't many of the beneficiary stakeholders intermediaries? And as they become more established, wouldn't the cost of mediation rise over time?
Yeah, thanks for this question. So yes and no. I thought about this quite a bit as well, and I think we have to differentiate between the Bitcoin protocol and the ecosystem. So what the difference is between the current payment system and the Bitcoin protocol is that you can send payments over the Bitcoin protocol without any of those intermediaries, and that's the brilliance of Bitcoin. Whereas we cannot send money around the world without the banking infrastructure. So these intermediaries that we have right now, they are embedded in the system, and we really need them to make the system work. And that's why they can take fees out of our transaction. But I agree that with the ecosystem building around Bitcoin, on top of the actual protocol, that yes, intermediaries will be charging fees, and it will make it more costly for us to transact. And there's also another reason for that, which is that the way mining works at Bitcoin and the rewards that are paid for miners, they will at some day disappear. In the year 2140, no more Bitcoins will be issued upon mining. And so then transaction fees will rise because miners are necessary to run the blockchain.
Okay, thank you. From Randy Wheeler, who asks, assume that I want to buy something and want to be sure I receive the goods. As well, the merchant wants to be sure they receive the money. Are there escrow companies that ensure the transaction is satisfied both ways? That is, the Bitcoins are released to the merchant when the goods are delivered to me. And then he comments, credit card companies generally perform this, and they absorb the risk.
Yeah, that's a really good point, because transactions are irreversible, right? So if I send my money, I know I can't get it back. So how do I know that I will receive the goods? And Nakamoto actually wrote this in his paper. It's amazing, the foresight he had. He basically anticipated this problem, and the Bitcoin protocol, the way it works, allows for escrow mechanics to be implemented so that coins only get released when certain triggers are hit. And there are already developers doing that, where this is what I was alluding to before earlier with, for example, property rights. Imagine you're going to buy a house or something like that, where property moves. You basically have the potential to incorporate all these mechanics into the Bitcoin protocol. And there's something else called multi-signature wallets, where you actually need more than one private key to send money, for example, 2 out of 3 keys, which has made a huge impact on the security of the companies that are now working in the Bitcoin system.
Okay. Just a note here, for those of you who ask more than one question, we'll read aloud your first, and then to give everyone an equal chance, we'll read others who have come in after your second question, and if we have time, we'll circle back. This is from Fabrice. I've heard a lot about the blockchain's use beyond monetary transactions. Can you discuss this?
Yes. So I think, Fabrice, I just mentioned a few points. Maybe you posted this before I got to this point. And that's basically, it's very true, because Bitcoin itself is called a currency, and Nakamoto calls it a coin. But it's really a store of information. It can be used for anything. You could put a whole book and basically stick it into the blockchain, and it will be there forever, and everybody will know at what time, at what date, what person, or address, I should say, had put this book in there. So this way you can verify transactions not just with money, but really anything that's digitizable, I would say.
From Rowan Curran, building on what Fabrice asked, can you speak to IBM's Ethereum/Adept or other uses of blockchain technologies for distributed automated contract management?
I know that Ethereum and IBM are working on this, and there are a lot of other projects going on. Ethereum is definitely the front runner with brilliant man behind it. And I cannot speak very much to that, I'm afraid, but I can definitely take this offline with you if you like and give you some either more information or also some context, because at the Bitcoin conference yesterday, nobody was speaking about Ethereum, but there were some other interesting conversations, for example, about sidechains.
Okay, our last question is again from our friend Jeffrey Cutler, who says there's obviously a lot of talk of innovation. In what part of the Bitcoin ecosystem do you believe it is especially exciting and worth watching?
So I think I'm personally a big believer in the international money transfer idea for several reasons, and this is really Bitcoin 1.0 we're talking about. This is moving money around. Bitcoin 2.0 is all the other things that are not money, like say contracts and other assets. And I feel that right now the banking system is really ripe for disruption. I used to work in banking for many years, and actually the reason why I came to Bitcoin was through my own idea of a peer-to-peer payment network around the world, just basically people exchanging euros for dollars or yen with each other without having to go through banks and saving themselves all the fees. And then I stumbled upon Bitcoin and realized that would be the rails that you could use to do exactly that. So I feel this is going to be one of the big early hits for Bitcoin. And actually there are companies like Circle Financial already doing that.
Okay, great. Sascha, thank you very much. Thank you everyone for attending. If you are interested in another webinar on Bitcoin where we can go deeper, please let me know. My email address is in the chat section. I'll repeat it. It's S as in Sam, LAVIN @MIT.edu. Sascha, thank you very much, and have a great day, everyone.